This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant Nair. With me, my colleagues Nigel and Ekta is with us here for the next 2.5 hours, guys. Hi, good morning, Ekta. Morning.
Hi, Prashant. Hi,
Morning.
Nigel. Well, yes, definitely a surprise edition, I would say, for this Monday, considering all the colleagues have gone on leave. But nonetheless, it is holiday weekend, and we're getting into holiday mode, and that's pretty much evident in terms of the markets as well.
Well, it's the most wonderful time of the year, right? You know, so...
especially when you have leave coming up next week.
Yes. I mean, I wish it was somewhere this week, but you're getting the Christmassy feeling. But I think the weather is not really changing. I thought it'll get a lot cooler till now.
Yeah.
But anyway, let's hope that happens. But Christmas is almost here, so...
But I agree, the anticipation of it is probably sometimes better than actually doing it.
just 300 hours left in this calendar year, and it's done and dusted.
We'll have a clock running, the hourly clock running, and counting us down to that 300th mark in a bit.
And when you come back, remember, it's earnings season.
Yeah. So let's keep that out of it. But let's get straight to the market action.
So. Absolutely. What fortnight we've had, right? You just sort of... So, what I want to do is start by not telling you what happened on Friday, but actually just kind of rework our memories and kind of talk about what happened over the last 2 weeks, because it's been absolutely astounding, absolutely bullish kind of up move over the last fortnight, the last 2 weeks. So two things happened, right? The first week, the first of the 2 weeks I'm talking about, we of course had the state election results. Market saw a big move, and then the market went into a consolidation kind of a phase, and boom, you had on Wednesday the Fed, in a way, kind of talking about a pivot. They said that rate cuts are coming into view. So one was local, it was followed up with global, and the end of it, over the last 2 weeks, the Nifty has added 6%. The Bank Nifty is added 7.5%, and you've got the mid-cap index, which is added 5%. So this is, as strong a gain as they sort of come. Now, just to add to the flow picture, right? FIIs, I just looked at since that state election result, since that Monday. By the way, flow started coming in the Friday before, Thursday, etc. But forget all of that. From that Monday, over the last 2 weeks, FIIs have bought 28,000 crores worth of stock. That's almost about $3.5 billion. This includes, of course, blocks and, passive flows, the FTSE change, all of that. But foreigners have net bought 28,000 crores. That is a very large number to come into the market, any market, in the last, in just 2 weeks. Now, with the sector, I mean, we've been talking about PSUs, and we sort of put out the PSU as the leader once again on that Monday after the state election results. But this latest sector to join this rally, this party, has been the IT services sector. Last week, it added 7%. Over the last 2 weeks, it's up 11%, right? The bulk of the gains came in the last 1 week. US stocks, by the way, have also seen a completely 180-degree turn in sentiment. Remember, India has been doing well, even without any help from the global market, etc. Dollar rising, yields at 4%, 5%. The market here did not look very vulnerable. So we've been doing well, but the US market had not been. But there's been a big turn in sentiment. The S&P last week hit a new year-to-date high, and it's just about 2% off fresh all-time highs. I'm talking about the benchmark S&P 500. Yields are down about, 110 basis points, more than that, from 5% to 3.9% wherever we are in the last 8 weeks. So, these are very large moves once again. Now to come to, this is the backdrop that we are coming into this new week and the end of the year, etc., right? And markets are laser focused on the fact that the Fed Chair Powell has said rate cuts are coming into view. The first full 25 basis point cut is going to happen in May, etc. But on Friday, a historically dovish Fed member, Williams, he pushed back on this rate cut thesis. In a sit-down interview, he basically said that we're not really discussing rate cuts right now. He maybe wanted to push back on financial markets rallying and getting too hot and excited, right? But that's something we need to take note of. Data kind of supported his view because you had industrial production numbers and you had services PMI, both of which came in strong, much stronger than expected. But markets have not really paid attention to this yet. I'm just saying that it's so bullish out there, you got to start to watch out for risks. I mean, it seems like nothing can go wrong, and that's when things actually start to falter a little bit. On Friday, the dollar index, for example, went up about 0.6%. We're at about 102.59. And I would say, not just here in India, in global markets, a lot of positivity is baked into stocks at current levels, right? So you have to be mindful of the fact that, this is the case. Markets are forward pricing mechanisms, and a lot of that positivity is being priced in very, very fast. Just an example, to take the case, the All India Institutional Survey, which is widely regarded as a pretty good indicator of tops and bottoms, that spread, bull-bear spread, is at plus 32. It's the highest reading since April 2021. Guess what happened in April 2021? The first Fed hike, right? The cycle began, the hike began. Now, this is telling you that you got to be mindful that markets have done well, and it's not as if you're starting at the base or at a very low base. Now, Nifty on Friday, just to circle back to levels, continued its upward momentum, and it's looked very good. Channel resistance for the Nifty, just to look at levels very near term, it stands at about 21,750. I thought there was a great gap when I mentioned that 21,750 level on Monday, but in 1 week, we are about 250, 300 points away from that level, but that's the first resistance. And the big gap area between 20,950 to 21,074 should provide support on the downside. On the Nifty Bank, you basically at new highs, so you just have to project higher. But I just like to put out support. The 40-hour exponential average is 47,379. It's looking good out there. It's looking just too good out there. And there's no reason to be skeptical for the heck of it. But just, don't go wild. Don't go chasing things without, which makes no sense. And there is that kind of stuff showing up in the market in various pockets, etc. as well. The GIFT Nifty is indicating about a 70-odd point lower start. So a little moderation, at least at the word go. Ekta.
Well, Prashant, I'm just going to build on those statistics that you brought out, because month to date, it's been an absolute rally for our markets. Nifty up 6.5%, sensex up around 6.7%, mid caps up around 6.24%, small caps have rallied around 4% the least, but they've outperformed on a year-to-date basis. Nifty Bank is up around 8.2%. We don't have the numbers up, but I just want to point out that, in terms of the PSU banking index, that has rallied 14% this month itself. The PSC index has rallied 12.5%. And like you mentioned, the IT index is up close to 10%. So these are the indices which we need to watch out for in terms of incremental buying. For today, yes, Asia is a bit lower. It could be consolidation. We have Brent crude, which is inched up a little bit, and the GIFT Nifty indicating that maybe there could be some amount of profits taken off the table, which wouldn't be too much of a bad thing. The other thing, Nigel, is that FIIs, they've pumped in money in the month of December.
Yes.
And this is a time when most of them are on holiday.
True.
But nonetheless, over 25,000 crores in terms of a net buy figure, which is coming from the FIIs. And we have the DIIs, which have supported as well.
Well, I'll tell you what, on the FI number, why it's even better is because in November, in November, we had a buy flow, but it wasn't as good as what Taiwan or even the South Korean market saw. In December, in fact, we are getting a larger chunk. Yeah. So it's making you feel even better. So the FI flows are very, very good. And if you just take a look at the texture of the markets, the Nifty is moving up. Both the pillars of the markets are firing. So the IT index as well as the Nifty Bank, both of them are doing well. And when the double engine fires, well, it's always very, very good news for the Nifty itself. So the uptrend on the Nifty is well and truly on. The bulls, well, they'll be looking to trail their stop losses since now the Nifty, we're talking about around 21,000 odd. We're almost at 21,500 approximately. But what stood out last week was that the large caps, well, they are coming to the party now. And it appears they're in for some kind of outperformance, at least in the near term. They outperform both the mid-cap as well as the small cap on Friday, as well as for the past week itself. What did the FIs do? Well, they covered some mild shots, and they added long positions as well. So that's why it takes long positions to around 60%. And in absolute terms, the long positions are at around 50,000 contracts. That's the highest we've seen in the last 3 months or so. So that's, a rather important sign as well. You don't want the net long position, though, go to that 90,000 or the 1 lakh mark. From there, we've normally seen that the markets cool off a little bit. So we're a distance away from there. The last time we saw more than 50,000 contracts out was a few days ago, but it's the highest since September 18th, 2023. On the options data, the put writing has really come to the fore. And that's why you're seeing, even in Friday's trading session, an uptrending market, 21,300, 21,400 put. Between them, they added close to around 1 crore shares odd. The premiums as well did see a sharp decline. And the 22,000 call, well, the start of the week, it was just ₹1 or so. It ended the week at around ₹8. So that seems that some kind of, out of the money put call buying is what we're seeing. And so a punt is taken there. If we see another 500 points, we'll make money. Otherwise, that contract will expire as well. Just 1 point. The PCR is gradually moving to around 1.5 odd. And that's when we see some kind of cooling off. So on the upside, well, sky's the limit. Now, the Nifty is in an uptrend. But on the downside, looking at the options data, the Friday's low is 21,235. That's a crucial mark on the downside. And since the 21,400 put did see a fair bit of addition, the 21,320 is the level that I'm looking at. So that's a crucial support zone. The GIFT Nifty suggesting a pullback. I think you need to participate on the upside, trail your stop losses. And if it gets stopped out, so be it. But, you need to play this market on the upside. The crucial factor is, does the Nifty Bank want to go ahead and test the 50,000 mark before the end of this fiscal? If that's the case, 22,000 is well and truly on the Nifty. So the Nifty Bank is the crucial one in here. 50,000, if it gets there, that's the number you need to watch. Should pull up the Nifty Bank at some point of time.
All right, Nigel, so that's basically the setup, as you know, from a rounded 360-degree perspective on what you need to know as we start another session. So 70 points lower on the GIFT Nifty is what we have as we start this fresh week. Let's get you some money market views in terms of how things are looking, some views across the asset classes. B% of ICICI Bank says dollar index moved lower, pricing an incremental a dovish Fed outcome. The rupee, he adds, supported by the dollar inflows and a weaker USD, appreciated marginally last week. He says with improved trade deficit and positive outflows for FPIs, he expects the rupee to face appreciation pressures but may be restricted by RBI's efforts to recoup forex reserves. In the coming week, he sees the currency between 82.75 to 83.25 to the dollar.
On the bonds, B. Prasanna says global yields registered new lows as the Fed pivot arrived much earlier than expected. He says back home, the RBI also relented, infusing much required liquidity in the form of the 7-day VRR operation in the wake of scheduled outflows. He adds local yields rallied with steepening bias on expectations of earlier than expected change in liquidity stance and positive inflation surprise. He expects the 10-year benchmark bond yield to trade with a positive bias between 7.10 to 7.25 for the week.
Well, we've got plenty of stocks to track for you. For the time being, though, we run you through the list. Let's run you through what all we're looking at in our top 10 segment. Infosys, Startup Power, Zydus Life, Mastercard Dock, sugar stocks, all of them will be reacting to positive news flow. So 5 in the green, while 5 stocks will be reacting to negative news flow. They include Z, United Spirits, Granules India, Solar Industries, and PB Fintech.
Okay, Fukin Yap is with Standard Chartered Bank. He's joining in to take some questions on the global setup. Fuk, good to have you with us here. Thank you very much. There's a complete turn in sentiment in the US as well. What do you make of it? The S&P, as I said earlier, about 2% away from a new high. Rally on?
Yeah, that's right. I mean, we just published our 2024 Global Market Outlook, which we titled Sailing with the Wind. So we do see the momentum in the global equities continuing, led by the US and Japan. And our view as well, our highest conviction view as well, is on the high-quality government bonds, where we've been seeing yields coming down. And as that comes down, it'll benefit your high-quality government bonds as well, because you get a capital appreciation on top of yield that is attractive at the moment. But in terms of risk assets, I think, our view is that the US continues to be strong as the Fed, as you mentioned, they're talking about the yields coming down and rate cuts coming in next year. That's very supportive for the US equities, since a lot of them are growth-driven. So as rates come down, that's very positive for the valuation of these US equities.
All right. Hi, Folk. Good morning. Good to see you in. Folk, since you're expecting, the equity markets to continue to rally in 2024, give us a couple of details. First up, how much of, what kind of Fed action are you factoring in? That's in terms of rate cuts. And from when does that start? Point number one. And point number two, you're bullish on global equities. What about the Indian markets? Where does it feature in the list?
Yeah, sure. So we are expecting that the economy in the US will slow down only markedly from the second half of next year. And as inflation comes off, then that's when you can see the Fed having the ability to cut rates. So in total, we're seeing about 125 basis points cut by the end of next year. But a lot of that focus in the second half as a weakness comes in because the economy is going to be slowing down. So 5 rate cuts, if you like, by the end of 2024. And that's because you see the inflation coming down, the Fed being able to respond there. So we like global equities. As I said, the setup is preferred in the US and in Japan. Within Asia ex-Japan, we're taking a neutral view, and India is neutral as well within that. But given that we like global equities, I mean, overall, we do like equities going up. But within Asia ex-Japan, actually, our preference is for Korea, where we see a turn in the semiconductor cycle. That's going to be very beneficial in terms of the earnings growth and the earnings rebound in South Korea. So India, within that, we are neutral. Within Asia ex-Japan, we'll go up together global equities. But the growth is good, but then you've got your valuation to contend with as well.
Okay. Fook, if you could just elaborate, why exactly do you have a neutral on India, and what is probably going to change your stance?
Yeah, I mean, we've had neutral in India for some time. This is on a 12-month outlook. We look at the growth as being very strong, and as you know, the structural growth story is very strong, and the earnings growth historically has been very strong, mid-teens as well. And compared to the other markets in Asia, it is very strong. But it's always just the valuation, which is very, very elevated compared to other regions. You've got China, which is at the doldrums in terms of valuation. Investor sentiment is very, very poor there. We think that a little bit of a surprise or anything just being stabilized could be positive for the market to rebound there. And then in the other markets, like I said, in Taiwan as well as benefiting from the turn in the technology cycle. But then in South Korea is our preferred pick in terms of the turn in the semiconductor cycle. We think that'll be beneficial for them. So India, don't get me wrong, we like the medium-term growth story, especially it's very, very good. We do tell clients in the call holding. But as we look at the 12-month view as a rebound, what we see as the best opportunity at the moment within Asia and Japan, our view is with Korea.
Okay, all right, Fook, we're going to let it go on that note. Thanks very much for joining in, as always, and giving us your view on the Indian markets as well as the global setup. We need to take a short break. Our list of top stocks lined up next. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. Embarking on a quarter century of excellence.
Welcome back to Bazaar Morning Call. Well, let's get to our top 10 segment of the day, and we have a lot of stocks to cover. Our research team is standing by with the CNBC-TV18 list of stocks for the day that you need to be tracking. Let's start with Manglam. Manglam, you're watching Zee Entertainment. A lot of news over the weekend.
A lot of news over the weekend, and the most important one being that Zee has gone ahead and requested Sony to extend the date required to make the merger effective. Remember, the earlier date before which the merger had to be effected was December 21, 2023. And given the sort of uncertainty around this, Zee has gone ahead and made this request. The key issue to resolve before the merger is leadership, who takes charge of the combined entity. And apart from that, remember last week, we did have a resignation coming in from a non-executive director of the company as well, Adesh Kumar Gupta. And over the weekend, the company appointed 3 directors, Venkata Ramana Murthy and Uttam Prakash Agarwal, along with Shishir Babubhai Desai. And all of these have expertise in HR, legal, as well as financial sectors. So those are a couple of things we'll have to watch out for. Well, that the extension would happen was a foregone conclusion. Now the question is what Sony's response to this would be. And until the uncertainty is there, expect the stock to be under a bit of pressure.
Okay, all right, Manglam, thanks a lot for that on Zee. But, you're also filling in for Infosys. Tell us more about that.
Well, for Infosys, the news is that the company has gone ahead and given a pay hike to all their employees. They've kicked off their pay hike, which was delayed. So remember, the salary hike for Infosys is usually effective from April 1. This time around, it has been effective from November 1. And on Friday itself, a large number of employees received their salary revision letters. And the average increase across the board is below 10%. The fact that the company has gone ahead and increased salary should keep employees happy. However, it's below 10%, and that should keep the margins happy as well. Over the last 2 trading sessions, we've seen all the IT stocks jump, and Infosys has rallied about 8.5%. So expect the momentum on the counter to continue.
All right, thanks very much, Mangalam, for that. I'll come back to you for more. But Tata Power, utilities have been all in focus and in a good way. Vivek has got Tata Power in his sights. Vivek, hi, morning.
Well, good morning. Absolutely right. So Tata Power, the subsidiary of the company that's received a contract from NTPC. It's a 418 crore contract, and the company is going to go ahead and supply over 150 watt power of DCR solar photovoltaic modules. This is for an NTPC project that is coming up in Rajasthan. This is a solar power block. It's quite positive for Tata Power given the fact that the solar EPC business continues to get traction both from in-house Tata projects as well as government projects. So total solar EPC portfolio is now greater than 12.5 gigawatt peak of the total capacity that they have.
Okay, all right, Vivek. So that's the news on Tata Power NTPC. But Mangalam, busy morning for you. You're watching United Spirits.
That's correct. Over the weekend, there was news on United Spirits as well, where the company has received a claim worth nearly 365 crores coming in from an existing national institutional customer. Now, on its part, 365 crores would be a quarterly profit of the company, but the company has said that it's in relation to the previously concluded settlement with the customer, and all recovery claims made by the customer have been fully settled. So that leaves room for the company, going ahead and contesting this claim itself, and as a result of which they've said that they cannot decide the financial implications caused due to this claim. My sense is it won't be a very big issue for them because they do have the resources to make do this claim as well, but the fact that they are contesting it means that the overall likelihood of them paying would be lesser than this 365 crores itself. The stock should open in the red, but maybe the street takes this in its stride and we see it recover from the lows.
Well, that's right. On festive season, Mangalam, that stock always needs to be watched towards the end of December as well. But Ekta, give us our dose of pharma for today.
Whatever season it is, there's always pharmaceuticals alive, right?
The meds keep going.
So for granules, I'm watching that one, and I'll start with that, and then I'll move over to Zydus. So granules, US FDA has inspected their Virginia facility. They've issued 5 observations. The plant was inspected from the 11th to 15th of December, so maybe we could see a little bit of a downside on them. But it's important to note that most companies have been resolving their USFT issues. So let's see the reaction that the street will, give to granules. Zydus is the other one that I'm watching. They've received a USFTA approval to initiate phase 2 clinical trial for one of their drugs under development for Parkinson's disease. So phase 2 will evaluate safety as well as the tolerability of the drug, basically whether or not the efficacy stands in terms of safety for this particular drug. Remember, it's from the US FDA, and hence it becomes more positive because it's a strong regulator which has given them phase 2 approval. They've also received US FDA nod for a drug which treats seizures. This is from their Moriah facility, $249 million in terms of sales. So maybe, we could see some amount of upside for Zydus Life.
Okay, all right. Thanks a lot for that, Ekta. Well, let's wind this down then. Go across to Vivek. He's here to tell us about some more stocks in the news. Vivek.
Well, absolutely. First on our list, solar industry, some negative news flow coming in there. Unfortunate incident at one of the facilities in Nagpur. There has been an explosion and 9 people have lost their lives. The company says that the financial loss is limited to this particular building itself. The other stock on our radar is Mazagon Dock. The company has received a prestigious order. This is over $42 million worth, and this is for the supply of 3 multi-purpose hybrid power vessels. The delivery of the first vessel will be made within the next 27 months. So some order inflow here continues as far as Mazagon Dock is continues. The last stock on our radar is K-Fintech. Remember, you saw a very large block deal in trade on Friday. General Atlantic Singapore has sold 9.99% out of the total 48.2% stake in the company. The top buyers include ICICI Prudential Life Insurance Company, ICICI Prudential Mutual Fund, as well as Societe Generale, all of them picking up over 1% stake in Friday's block deal.
All right. Thanks very much, Vivek, for that. So those are a bunch of more stocks to watch out for. But sugar companies should also be in favor. They've been kind of on the wrong end of the receiving end of things for a while now, but some relief at the margin maybe. Manisha is here with details. Manisha, morning.
Morning, Prashant. Thank you. Well, yes, some sweet here, and all the meetings that the sugar industry has been having with the OMCs and the ministries finally seems to have worked out. So the government over the weekend did reverse decision to ban use of juice for ethanol making. But what they also have done is that they have put a cap on the diversion of sugar and B-heavy for ethanol at 17 lakh tons. So official suggests that 6 lakh tons is something that already has been diverted in sense of sugar for ethanol. Do remember that 20 out of the 157 mills which do make ethanol make it from juice. So these 20 is who were getting affected, and these are one of those, many of those bigger mills as well. And there have been many representations that we've seen being made since 7th of December. That is in government and syrup for making ethanol. So the change in stance after representation from the sugar industry has been a big positive. What the industry is now waiting for is the ethanol pricing. I mean, that has been delayed as well. Remember, tenders have already been floated. So that is something that is expected in this week itself that we will see. And that would be another positive, by the way, that we see a higher revision of ethanol pricing coming in for these mills.
Okay, all right, Manisha, thanks very much for that. So maybe we could see a couple of these sugar stocks in the green on the back of that relief. Well, here's a quick recap of all of our top stocks that we're tracking. Stocks with positive news flow are Infosys, Tata Power, Zydus Life, Maiscon Docs, as well as sugar stocks, while stocks with negative news flow are Z Entertainment, United Spirits, Granules India, Solar Industries, and K Fintech. Time for a short break, but up next we'll be talking to a market expert, Prakash Diwan, to discuss the fundamental stocks in focus. Stay tuned. And later we will be joined by Siddharth Mittal, MD and CEO at Biocon, to discuss their business outlook.
CNBC-TV18, embarking on a quarter century of excellence.
Moti Sons Jewelers,
Embarking on a quarter century of excellence.
Welcome back. You're tuned into Bazaar Morning Call. Well, we've listed all the top stocks you need to track. So let's get a fundamental analysis going then. Prakash Diwan joins us on the show. Hi, Prakash. Morning. Hope you're having a good morning, Prakash. Well, let's talk about a couple of stocks that may not have such a good start. Z Entertainment, they've pushed that merger date. Some were really expecting that. But how would you approach the stock? If it opens up a little bit weak, then would you look to buy into it?
Good morning, Nigel. Thank you. I think Z is getting into a stage where there are so many unknowns that are that keep coming, and there seems to be a basic question on whether there is any sort of a intent to get this done quickly. I mean, you've seen so many objections come from so many counts, and none of them have been resolved with any finality or any conclusive nature. So my sense is, it might be too early to start kind of, playing the drum rolls and things are moving fine, and this is going to be finally that behemoth that was anticipated to be created. So I would still want to kind of watch and wait, because it's not something which is really offering any great value if this uncertainty, which is far bigger in terms of an impact, is looming large. So give it some time. Let things go a bit decisively into the right direction. You may end up seeing a bit of an upside post that. That's fine, but at least that there's no time correction that's likely to happen now. So we would like to kind of look at it from a different angle at some point in time later, but not at this juncture.
Okay, Prakash, hi, morning. Good to see you in. Would you have a view on any of the IPOs which are opening? There's Muthoot Microfinance, Suraj Estates, Moti Sons Jewelers, Happy Forgings, Credo Brands, RBZ Jewelers. I mean, it's really a Santa Claus end to the IPO market as well.
Good morning, Ekta. Good to see you on Bazaar. I think the IPO market is clearly giving an indication of how smartly promoters and investment bankers are capitalizing on this FOMO that's been built. Look at the intensity, look at the kind of frequency or rapidity of all these IPO issues post the verdict from the 3rd December assembly elections. So it was almost like people had timed it in such a way that if this is going to be the outcome, the next follow-up is going to be. So in just 10 odd days, you've actually seen corporate India mop up more than something close. I mean, I'm not talking about the oversubscription part, but in terms of sheer issuance of primary paper, it's been around 35,000 crores, and that is significant. So what's not happened in the last 4 months is actually happened in the last couple of weeks. And this tells you that there will be a lot of IPOs which will pass through this whole, this deluge of sorts without actually coming up with or offering any quality. I'm particularly not a very big IPO investor fan because very simply, I feel post the IPO, post the price discovery, you are far better off than kind of, just speculating on whether I will get some allotments or not. So it's become more like a, game of, just applying for it, looking at some sort of a listing bump up and then kind of negotiating your way forward. But some of the IPOs, the quality ones that have come through like Tata Tech or even IREDA, those are what you would want to kind of focus on. In the new list that you mentioned, to be honest, I have not found anything very exciting, even from a post-listing perspective. I mean, in fact, there are some of them where there are lots of questions being raised about the credibility of promoters and things like that. So, it's that kind of a season where people are generous enough to kind of, apply for anything that's coming as long as it's primary. But I would wait for some of these older ones to kind of, start being available at value zones. And that's what I mentioned earlier. Not looking at these IPOs at all. And the only thing that stands out is that some of these, like Muthoot Microfinance, for example, now they are getting into they are into that business of MFI. It is looking very positive. It could do well for them in the future, but look at the pricing, and from that perspective, it might again not offer you the same risk reward benefit that you have.
We have a discussion with the IT analyst coming up at 9 o'clock. Prakash, hi, morning. But just wanted your first thoughts. That's the the latest sector to have joined in with a 7% rally last week. So what's the call here?
Good morning, Prashant. So I think it's more correlated to the expectation of improvement in the situation on the ground in the US very clearly. I mean, as you highlighted, from the anticipation of the Fed's rate cut intent for the next 1 year. I think that kind of starts telling you that there could be some sort of a revival, and January is typically a very good time for new contracts to kind of start crystallizing. And if Infosys has just issued a nominal hike, of course, it's probably token, not something which is very wholehearted. And it's got delayed by a few months. It tells you that there are companies which are very clearly looking at retention now, and retention is usually in anticipation of new work coming along. So if that's the case, you could probably see some revival. I think from a valuation perspective, IT does offer you that cushion. So it's a similar thing which banking did for some time, when the bank nifty was at about 40,000, 41,000, and it's now kind of, almost in kissing distance of 50,000. So you've seen how undervaluation kind of, plays a more important role when liquidity is a criteria rather than just fundamental, seeking fundamental parameters to be improving. But I think IT will probably see some. I like some of the names out there, to be specific: HCL Tech, Infosys. These are names that will probably race ahead faster than the others, while the others might take some time to catch up.
Okay, all right, fair enough. Prakash, we do have a couple of more questions. Stay on, but we have a piece of news to cover from the pharmaceutical space. Newspaper reports have suggested that Biocon is in talks to sell its API business, but the company tells CNBC-TV18 that there is no truth to the reports of them looking to pair off their API business. To discuss this and more, we have Siddharth Mittal, who is the MD and CEO of Biocon, joining in. Mr. Mittal, thank you very much for taking the time out. The newspaper article indicated that the company is looking to sell off its API business. We've already got a clarification from you, but if you could just comment on the news.
I think we clarified that this is absolutely a baseless rumor and a speculation. The generics API and formulations business is a very important and integral part of our overall group strategy. And, we are investing heavily in this business, both in creating a very robust pipeline of differentiated molecules and in capacities. So, there's been no strategic intent of divesting this business.
All right. While you have clarified that you aren't, the idea of pairing off the API business is to reduce debt on books. The debt on books for the consolidated entity is around $1 billion. This is after the Viatris acquisition. What then is the plan to reduce debt?
See, the debt is at Biocon Biologics level of $1.5 billion, of which $1.2 billion was taken to fund the acquisition of Viatris business, and there's $300 million of debt which was taken to fund capex for Biocon Biologics. But when you look at the Biocon Limited or the parent company, it does not have any debt. It has cash which is being invested in creating additional capacities, as I mentioned. Plus, Syngene continues again to be cash positive. Now, Biocon Biologics is looking at various options to reduce its debt. Recently, we had announced sale of non-core portfolio of assets to Eris, and that's of course going to bring down part of the debt. But like that, we are in discussions also with few private equity players to raise debt directly at Biocon Biologics level. So we should look at the debt reduction at the business level. Of course, Biocon is the holding company for the biosimilars business, but the business is looking at raising funds either by way of divesting few more non-core assets or by taking on additional private equity funds.
All right. Hi, Siddharth. Morning. By when will you raise private equity funds, though? Give us some details on the timeline and what could the mix be?
I think it will be purely speculative if I talk about the mix and the quantum. I think we are definitely looking at getting the debt levels to an acceptable level till our business, performance starts reflecting a very comfortable debt coverage ratio. And today, in terms of timeline, we don't want to definitely do any of these activities in a rush, which does not give us the best value for what we are trying to do. So I would say that the efforts have been ongoing since last few months, and we definitely expect that these discussions would get over sooner than later. But very difficult to pinpoint specifically when and how much would be the quantum of these activities.
Okay, all right. But what is the outlook on the generics business, Mr. Mittal? Previous quarter, the sales were up around 4% and it was impacted by pricing pressure, phasing out of a key product. And this generics business includes your API business. What can you guide on?
Absolutely. So the generics business includes both API and formulations. Our formulations business is continuing to grow at a high double-digit growth rates. Our API business has been under pressure, as you said, that because of pricing pressure, which is being faced by our customers, and also some of the stocking that few of our customers had done, anticipating tenders, which they were not able to secure, and hence they are trying to liquidate that inventory now. But overall, looking forward, the generics business has a huge potential. We are looking at a few differentiated molecule launches in calendar 24, end of calendar 24, early calendar 25. There are a few peptides which has a huge potential where we are investing a lot in the space. And some of these peptides will be in the market in early part of 25. And I think that would drive a good double-digit, high teens kind of growth for the business. But in the short term, we would continue to face challenges as we have seen in probably the first half of this fiscal.
Okay, fair enough. Mr. Mittal, the company has mentioned their interest in GLP-1 inhibitors, which is basically the weight loss drug space. Is that segment that y'all would be interested in when it comes to API supplies?
So, let me first contextualize the opportunity in GLP-1s. Today, GLP-1s are used to treat diabetes as well as weight loss as two very important growth segments. And of course, there are other GLP-1s treating other indications. But today, if you look at various analyst reports, the GLP-1 market is expected to be over $100 billion over the next 8 to 10 years. And this business is directly under our generics business. And we do have both pillars where we are targeting the API business, where we'll be supplying API of these peptides to our B2B customers, as well as we are looking at our direct entry in few select markets. So I think we have announced a couple of collaborations, partnerships for peptides. I think last year we had announced a collaboration with Zentiva for pan-Europe commercialization. Recently, we announced a collaboration with Juno for Canada. And like Juno and Zentiva, there are many other customers in key emerging markets where we are signing up for commercializing these drugs.
Okay, just before we let you go, quickly tell us about Bicara, because the news was it will cease to be an associate company with that $165 million of Series C funding, which it just received. Tell us, what does this mean for Biocon in terms of future investments?
Bicara, of course, was founded by Biocon and was incubated from Biocon. But the idea for Biocon has been to get most of our subsidiaries and key businesses independent, which means doing their own fundraise, looking at its own monetization plan. Monetization can be in any form, and IPO is just one of those options, like we discussed for Biocon Biologics. For Bicara, has had a very successful fundraise thus far. So Series C was a very successful fundraise that we just closed, and with that, Biocon will be roughly 14% in equity stake in Bicara post this Series C round completion. And Bicara would continue to look at funding its need for development of its pipeline, either through additional fundraise or through an IPO, or even the options could be anything. I mean, if there are strategic buyers interested in the asset, we can look at that option as well.
Okay, all right, Mr. Mittal, we'll leave it on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from Biocon, clarifying on reports that no, they're not looking to sell their API business as of now. We need to take a short break, but up next, Mitesh Thakkar and Sudarshan Sukhani will join in with technical trends this morning.
CNBC-TV18, embarking on a quarter century of excellence.
Sir, is there a wedding?
18, embarking on a quarter century of excellence.
Welcome back. You're tuned into Bazaar Morning Call. Well, we have been telling you that the GIFT Nifty is indicating that we're likely to see a 60 to 70 point downtick. So let's see how that goes. But from a bullish perspective, if you get something like that on the screen, I think it may not be such bad news for those that are looking to get in. Mitesh Thakkar and Sudarshan Sukhani join us to help us out with the technical strategy. Good morning, gentlemen. Well, the markets have been going from strength to strength. Mitesh, you go first. Tell us, what's the trade on the Nifty?
Morning, Daniel. We've had a very good rally. And I think, the last couple of days of consolidation was around 21,000. Then we had about 3 days of up move, and we tested the target of around 21,500 possibly. And now I think, you might get a pullback for a day or two. So I think anything closer to 21,250 would be a buying chance for me. Today is about 60, 70 points lower. So you might want to wait for another 100 odd points. But yeah, the trend remains firmly on the upside. So you will have a couple of down days, pullbacks to the 10-day averages, simple averages, etc. I think that should be the buying chance which traders should look at. So wait for levels of around 21,250, 21,300. That's my entry zone.
All right. Let's just get Sudarshan in as well. Sudarshan, morning. What's your view? The Nifty, Bank Nifty, massive last 2 weeks.
Yeah, good morning. See, the trend is up and we should be buying, but I had suggested taking profits. And now the chances are that we can enter into a consolidation. So there's no rush. Maybe wait for a couple of days or 3 days, and then we'll find the support levels actually come emerging. Then buying should be considered. I think we can take rest for the first 2 days.
Okay, fair enough. Mitesh, morning. In terms of individual ideas, what's on your list today?
Morning, Prashant. Despite the fact that we might have a slightly negative opening, I have more of buy calls, and they are on IDFC Limited, which I would recommend buying with a stop at 124 for targets of 134. Oracle Finance, and the entire IT pack looks very good, and one of the sectors which could possibly be outperforming in the next couple of weeks. So you'll have a lot of IT calls coming up in the next few days. Today I have Oracle Finance. Look at stop at 42.60 and target of around 45.75. And Asian Paints is a conditional buy. It needs to clear Friday's high of 33.30. Then buy with a stop below 3,300 for targets of around 34.10. And one sell call that's on ICICI Prudential, which I would recommend selling with a stop at 5.30 for a target of around 500.
Okay, so Darshan, what about you? What would your picks be?
Well, it's a mix, an equal mix of buys and sells. The sells first, Dr. Lal Pathlab. Lal Pathlab is the intraday short. The stock suddenly went into a fairly bearish pattern, suggesting an intermediate top is in place. Sell with a stop above 25.75. Metropolis is another intraday short. A bearish head and shoulder pattern is almost being confirmed. Short sell with a stop above 16.45. Short selling should always be done only intraday. I have SBI cards where apparently a bullish pattern is under completion. Maybe, some stocks will do their own thing even if the Nifty consolidates. This could be one of them. Buy with a stop under 765. And Tata Motors, which broke out of a 7-day consolidation and is at new highs, is a buying opportunity with a stop under 720.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's get in some derivative strategies. Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, joins us on the show. Hi, Chandan. Morning. Santa did come to town last week, right? How are you approaching trade now? What are the strategy you have in place?
Good morning, Nigel. Thanks for having me. Really, Santa came and rewarded well, giving us cheerful moment, and I think long way to go. It may take breather for 1-2 days, but then all set to hit the new highs towards year end. So as of now, if you look at the Nifty internal, index long short ratio from FIs are 60%, indicating that they are having 60% long position, 40 shorts, indicating bullish stance from their side. Put call ratio is holding near 1.47. We have seen spurt in PCROI. As we have witnessed sustained put writing, all immediate strike call unwinding is also visible. Only concern is VIX is again at 13 marks. However, till it remains below 13.5, 14, we are comfortable. But slight high in VIX might see some sort of swings in between. But trend is intact, and we believe that index is continuously making higher tops, higher bottom on the weekly chart until it holds about 21,250 zone. Overall, we are expecting this rally to extend to us 21,750 to 22,000. For day point of view, any decline could be bought with support of 21,250 for an upside move to us 21,500 plus. Now, looking at the Bank Nifty index, Bank Nifty also witnessed good move. Technically, it gave a breakout from its pole and flag pattern. Data setups are positive. We are witnessing sustained put writing at lower strike. So again, buy on decline stance could continue with support of 47,500. We are looking for 48,750 kind of level in the banking index. Now looking at the stocks, first trading idea that is buy on IDFC Limited. After a long time, this stock is coming on radar. We have seen some derivatives OI built up with delivery volume. Multiple rounding formation pattern is visible on the daily chart. In fact, it gave a breakout from a small pole and flag pattern, and trend is shifting for the next year up. So recommending to buy on IDFC Limited with support of 124. Stock has potential to head towards 133 level. Second trading idea that is buy on BSOP. We have seen a decent rally in most of the IT stocks. Nifty IT is doing well along with movement in Dow and Nasdaq. So IT stocks are likely to see the cheerful move ahead. BSOP is our preferred pick. The stock is continuously making higher tops, higher bottom formation. Clearly outperformance compared to all the sector and peer stocks also indicate strength and momentum could continue. So one can buy BSOP with support of 710. It can head towards 750 level. Last trading idea, there is buy on NTPC. We are positive on most of the power name, and we believe that power will continue to keep the power and strength going forwards in the end of this year and upcoming year as well. So NTPC is one of the best idea. Can buy with support of 295 for an upside move towards 325 levels.
Okay, all right, Chandan. Thanks very much for joining in and giving us all of those F&O picks. We need to take a short break. We'll come back with the pre-opening, and also with us will be Apurva Prasad of HDFC Securities, who's going to put the focus on the IT sector. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
Go powered by
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, this is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We have Prakash Diwan still with us. Prakash, I just wanted your quick thoughts with regards to Edelweiss Finance. They've come out with this Edelweiss Financial Services, rather. They're going to be selling around 10 to 20% stake in Edelweiss Alternate Asset Management. They're probably going to rake up around 1,500 to 2,000 odd crores. Have you looked at the stock? It's done well on a year-to-date basis. But any credence to this piece of news? How would you approach the stock?
This has been a stock that's probably been overlooked by most of us in the market, given the fact that it hasn't been doing much of mainstream activities, as much as some of the other peer group players are. But, the kind of pedigree that it has, the kind of client relationships that it has, it is bound to fetch some sort of, salience when it comes to valuation, right? So I think from a forward-looking perspective, this sector as a whole is going to be extremely positive. The financialization of savings, the kind of participation levels that we are seeing, all of that is positive. But whether you want to bet on something which needs a lot of repair or repair at regular intervals from a balance sheet perspective is the question. And if you actually ask me, I've always played this part without buying into broking outfits or, some of the asset managers, but rather gone for the service providers to all of these. And from that perspective, CAMS and KFin Tech stand out as absolutely clear choices. Of course, CAMS is run up a bit. It's valued a bit more richly, but KFin Tech, to my understanding, is still offering a lot of long-term value. And there is very clear visibility. So you'll probably have a repeat of what CDSL did in that sense. So from that space that you allude to, I would not really specifically look into just one stock and risk myself from a more micro perspective, but from a macro perspective, the other service providers offer far more value.
Yeah, no, absolutely. Got it. Just a quick word on a few big movers from Friday's session. IREDA. Right, I'm only mentioning it because it's gone so much. It's gone through the roof. Volumes were super strong. Was down 10%, and there were a lot of pending orders on Friday. By the time we closed, a quick word on this one, delivery was another one which sold off sharply. I don't know if you have any thoughts on these names.
So, Prashant, IREDA, of course, continues to be in focus given the kind of love that most institutional investors have also demonstrated for it, and particularly from the FI side. It's a very clear proxy to the renewable growth story in India, and we've seen how the metrics look so positive for a fairly longish period of time. So there's a huge justification for buying it at higher valuations also. But I am from the camp that believes that someday the tide will turn. There will be a lot of the easing out of this FOMO and craziness around buying into some names like this, and you will probably get it at softer valuations without the business model getting impacted. It's very similar to, let's say, a Gandhar oil refinery, which was also one of those co-IPO debutants of sorts. We've seen the numbers come through. There's nothing wrong with the numbers except for 6-7% off on a YOY basis, but at 3,000 crores market cap, some of the, Gandhar has a product suite which is so promising. People have ignored that at the cost of all the interest in IRD. So you'll always have relativity also coming into picture in some of these stocks. So I would wait for IRD to soften a bit before buying. On the delivery, I think it's more to do with the kind of expectation of revival in the e-commerce side. The ONDC part is still not kind of emerging as a very strong number-driven, profitable business, except that, some building blocks are getting put into place. But I would believe delivery at this value, at this level, does offer far better value than it did, let's say, about a year back. So from that perspective, yes, but these new age businesses can surprise you on outcomes, particularly on the earnings side, quite dramatically. So you have to take it with that gumption of, taking that risk. But, there are far better names available in the old economy stocks as well. We'll stick to that. But yes, if somebody has delivery, it's worth a hold, given that there would be revival and the things could repair very fast.
All right, Prakash, we'll leave it there. Thank you very much for your time. Great speaking with you, and have a profitable day, profitable week ahead. IT is the latest sector to join the big rally. Apurva Prasad, research analyst at HDFC Securities, is with us. Apurva, great to have you with us here. Thanks very much. Has anything changed on the ground is the question. Stocks have moved, and big moves. The index is up 7% last week, 11% over the last 2 weeks. But have you spoken with, companies, and what are they telling you?
Sure, good morning. So Prashant, we've been doing our checks, and if I look at the lead indicators, most of these suggest that pressure on discretionary sort of still continues. Look at indicators such as tech job postings or some of the hiring metrics. Those still continue to be relative lower levels. Having said that, what we're looking at is some sort of a normalization as we look into FY25. So I think that being one element. Second being with a lot more focus on margins and some of those factors determining the operating profile is a lot more favorable for the sector. So I think these two become a lot more prominent. And if I can add, the third element out here is the mid-tier IT outperformance, which I think should continue going forward. So I think the overall growth premium that most of the mid-tier IT gets over tier 1 IT, that looks to be a lot more secular and sustainable.
Okay. Apurva, hi, morning. Thanks very much for joining in. This news on Infosys and the salary revision letters that they've given much earlier than what is generally the norm for the industry, how would you read it?
So it's actually, these were deferred, and they are sort of been giving the wage hikes which were deferred from first quarter and some from the second quarter. So I think it's probably more an indication of what was pointed out earlier. So yeah, it's not an advancement, it's more a deferment. And those are some of the elements which did enable most of these companies to hold margins despite what we saw over the past 2 to 3 quarters. There were companies where the revenue run rate was lower by about 8 to 10% in the last 3 quarters, yet they were able to hold margins. A lot of this was attributable to the fact that wage increase, which is the biggest cost element, those have got deferred. The good news is that that's coming back. And that is some sign of demand. So at the same time, if you see over the past 2 quarters, there have been mega deals that have come through for most tier 1 IT companies. And what that does is not just give a relatively stronger exit to FY24, but a decent probability of recovery in FY25. And with most of those deals, the ramp-up schedule looks to be pretty much on track.
Yeah. Apurva, hold on to that thought. We'll come back to you. Vivek Sarogi is now joining us. We're talking about sugar as a space and the relief, the limited relief that has been provided by the government. Let's understand what this means for companies. Vivek Sarogi is Managing Director at Balrampur Chini Mills. He's joining us right now. Mr. Sarogi, good morning. Great to have you with us here on CNBC-TV18. Prashant this side. We spoke, a few days ago, and you'd explained in detail what the implications this could be. And you'd said that, well, the way this kind of hurts at that point was lower sugar prices. How much of a relief is what we've seen now, and how does this sort of help? Just explain that to us, sir.
Yeah, morning, Prashant. So yes, I'll pick up from where we left. So basically, at that point of time, the diversion, let's say, was there was a hard stop which was looking like 11-12 lakh tons of sugar sacrifice. From that, the government has recalibrated and understood the production numbers, distributed the sacrifice within juice and B-heavy, and a total sacrifice of 17 lakhs has been accepted. I think that is a very practical decision. And they've also put in a rider that every month they'll be looking at the production numbers and indicated that should the production numbers increase, they would, in tandem, increase the diversion. They would allow 17 lakhs to, creep up to the level of production increase, which they've estimated now.
Right. So overall diversion has been basically capped at 17 lakh tons.
Today, yeah, correct. Which earlier was looking capped at 12 lakh tons.
Okay. So how does this, is this you would term this as moderate relief? Does this solve the problems? Obviously, this is not what it was before. The notification came in earlier. And for Balrampur itself, which operates, I think, cane juice, standalone cane juice facility. I mean, I'm assuming this is good news.
Yeah, so it's good news all over. Let me just explain you the hues and the color of the good news. One, sugar prices do not, deepen the correction, and probably we've hit the low already in my mind. Secondly, it allows mills like us and others to have flexibility and run juice operations. One would not say 100%, but much better than what we were. So let's assume in our minds, we were running X. We'll definitely be 2-3X to that level, from that level. So it's a well-distributed, well-thought-out, well-calibrated relief based on the basic premise that there is sugar needed, and next year also looking slightly vulnerable owing to maybe a lower Maharashtra, Karnataka production. So this is a decision which I hail, which I appreciate, and I think all players from the industry have appreciated this, and there's very close coordination. We understood, the government understood our stand, we worked deeply, distributed the sacrifice, so it's fair to all the millers concerned.
So, Mr. Sarogi, what would this mean in terms of inventory levels? Because the fear was that there will be inventory levels built up. There could be an increase in terms of working capital on account of that as well. Are all those fears now assuaged?
No. Let me just complete that. So we are talking of what was expected, what has happened. I'm saying to that extent on the current reality, how the government is dealt with is now deeply appreciated. Secondly, if there is an inventory built up, we are okay with it. And I think any responsible industrialist stroke businessman should be, because there is a fear of a lower sugar production next year. Should that happen, one would definitely look to build up some inventory to feed the next year. So there will be inventory built up, which is appreciated, which is needed for next year. And should that not be needed, there are 100 ways of evacuating that inventory.
Okay. All right. Hi, good morning, Mrs. Sarogi, and thanks so much for speaking to us here on CNBC-TV18. Well, tell us then what's the numbers we should be working with for 24 and 25 in terms of ethanol production as well as on sugar, post this, this relief, so to call it, that has come about?
So as we said, the ethanol numbers are in front of you, and sugar production is up for grabs every month, where the government said it would be recalibrated. But I think ISMA has given out a number of somewhere between 30.5 to 31 million net of assuming a 17 lakh diversion. So 305 to 310 lakhs production after a diversion of 17 lakhs. I think that is the number we've given out. And let's assume this leads to a 20 lakh inventory buildup, so be it. It's needed in the system. And should it not be needed, as I just said, we have many ways, there's export, there is a long higher diversion next year. There is a definitive data which shows next year's production might be lower than this year.
So what would your sort of closing inventory be, say, for FY24? Is there a sense?
That's a good question. As per government data, the closing inventory was 57. So it could go up to 75, 77.
Okay. And for
but
Balrampur?
That's not a cause for alarm. That is not a cause for alarm.
Okay. And for Balrampur, would you be able to? For Balrampur, would you be able to provide the number, closing inventory? I mean,
we can't do that. Impossible.
Oh, okay. And you said that, in your opinion, prices have already hit a low. Sugar prices have already hit a low.
That's a very personal view. Yes, I feel so. The panic, I think the panic is now out of the system. There's no more fear. There's no panic.
Yeah.
It's well calibrated. We can plan our, where to make B, C, and juice as Balrampur.
Yeah. And where are prices now, sir, compared to earlier? Are they? You said prices could drop at least 5%. Are they down 5% from that point?
No. I think that 5% probably on that day looked more real, not now.
Got it. Mr. Sarogi, it's a pleasure, sir.
Yeah. Not so bad.
Not so bad. Great conversation. Thank you for picking.
Much less than 5.
Much less than 5%. Thank you very much for joining us and sort of clarifying. Your stock is up 7% as we speak, so the relief is real, and markets are bidding these prices high. Mr. Sarogi, great to have you with us here. Markets have opened, so I think we need to look at what we are getting. 80 points lower, so in line with what the GIFT Nifty was indicating, 21,370.
Well, that's right, Prashant. We're down closer on 90 points as we speak. JSW Steel, that's the top loser, down 2.5%. Infosys and ICICI Bank, both of them are the big heavyweights, and then both of them have opened up with a cut of around 1%, and they are contributing maximum on the downside. You have Mahindra and Mahindra as well, that's down a little bit. And in terms of the stocks that are declining, actually, the three big I's are lower. ITC, Infosys, as well as ICICI Bank, all of them lower in trade. On the flip side, a few stocks that are in the green. You have Bajaj Auto. The two-wheeler names are doing well. Bajaj Auto, Eicher Motors, both of them doing pretty well in today's trading session. And the Nifty Bank actually is a bit of an underperformer today. So let's see whether or not that dip gets bought into. From the broader market, Zee Entertainment, that's under pressure. That's down close to around 4%. India Cements is down close to around 3.5%. And Metropolis in pre-open was down close to 5%. It's opened up with a cut of around 2.5%. Ekta, all about the sugar name seems like.
Yes, absolutely. Well, it is a lot of the sugar names which are spiking. So Bajaj Hindustan, for example, is up around 9% We have Sri Renuka, which is up around 6.5 to 7% at this point in time. On the downside, just watch out for IREDA, because that stock is now showing further profit booking. It was down in Friday's trading session. It's down another 8.5%. Like Nigel mentioned, Zee Entertainment is too showing large amount of volume and price action. So that stock is down around 4% at this point. Edelweiss Financial, there was some stake sale news with regards to their AMC business, and that stock is currently down around 4.6%. The likes of Metropolis has recovered to a cut of around 2%. A couple of these railway stocks, which have seen a good amount of a run, are seeing some amount of profit booking, so that stock is down around 2% at this point in time. Overall, in line with what we saw in terms of the Asian markets. So we have the Bank Nifty, which is down around 277 odd points. The mid-cap index, which is down around 0.5% at this point. The Nifty down 70, and the sensex down close to 270 odd points as we speak.
No, absolutely. You know, by the way, we were in conversation with Balrampur Chini. Balrampur Chini is the biggest volume-led gainer right now on the index, right? So it'll come up on your screen. So 413, and look at the volumes, 2.5 million shares at the word go. It's right up there. Praj is another one, right? I mean, again, the ethanol play, 5.5% higher. Huge volumes in this one, 572 coming in on Praj right now. Bajaj Hindustan is up 10%. I think Ekta mentioned that. EID Parry is up 6%, 583. All these are sugar plays. Triveni is up 5.5%. Dhampur is up 8%. Dwarikesh is up 7%. Uttam Sugar is up 8%. So Dalmia Sugar is up 6%. I can go on, but sugar is the sector of the morning in terms of how we are starting. So it's a remarkable kind of recovery, at least with the word go, that we're seeing. A few other names. Mazgaon Dock is up about 3.5%, just moving away from sugar. It's got large volumes on it. There is VIP Industries, which is up about 3%, 3.5%. Sterling Wilson and Solar is starting about 4% higher, 4.5% higher. I think, more and more names coming through. On the downside, by the way, market breadth is almost exactly 1:1. I was talking about IREDA with Prakash earlier. It's down another 9%, and it's the largest volume-led loss coming through across the board right now. Huge volumes, 19 million shares. So there was a stampede in, and there is a bit of a rush out of that name coming through. Solar Industries, I think we mentioned, is down 7.5% now. Zee, of course, we mentioned, is down about 4% or so, and so on and so forth at this point in time. So that's the overall picture. 50 points. Already there is about a 30-odd point recovery coming through on the Nifty with what we've seen. Mahesh Patil is our market master of the day. He's Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, good morning. Great to have you with us here on the program. It's a pleasure. Just absolutely incredible last 2 weeks. It was kind of almost, I'm only half joking, but half serious. Very difficult to lose money in a market like this. At least it has been like that over the last fortnight or so. But what from here, Mahesh, in your opinion?
Yeah, good morning, Prashant. Yeah, so I think last couple of weeks have been fantastic. I think we've seen market probably discounting too early, right? The kind of conditions where we are seeing that now rate cuts probably will be much sharper in the US in the next calendar year. So essentially, kind of a more easy kind of a monetary policy, I think, is what cheered the market, but slightly running ahead of the fundamentals, okay, because not much change really in terms of the outlook over there. But I think overall, as we move forward, right, a lot of the risks which were there in the market in this calendar year, I think they are getting mitigated to some extent, whether it is on inflation. We're seeing inflation now anchoring now at much lower level. Even rate cuts also, we've seen a sharp rally in the bond rates. US, both as well US as well Indian bonds have yields have come up sharply. And then I think overall the growth concerns which were there in terms of whether US will see a deep recession, I think those are also getting eased off. Market is now looking at more of a soft landing. And even back home over in India also, we've seen that the numbers which have come in, right? The GDP numbers have also been on the surprise on the positive side, especially on the manufacturing and on the investment side, which was kind of people were expecting that, but I think that's clearly showing that the whole investment cycle is slowly starting to pick up now. So I think that gives a greater visibility going forward that the recovery which we have seen will continue to sustain, and that will ensure that the corporate profitability growth should be fairly good even going forward. So I think the markets are now slightly probably ahead of the fundamentals, I would say, but I think in a scenario where we are looking that the financial conditions would probably be slightly easier, and the fact that even if you look at volatility also, right, in Indian markets across the board has been fairly low. So I think in that scenario, I think the risk premiums, the equity risk premiums could probably expand, and that's what we're seeing. The multiples are expanding, and I think at this point in time, I think slightly cautious because the run-up has been too sharp, and in a few stocks, in a few sectors, it's is much higher. But I think for long-term investors, I think there's nothing to worry. I think continue with their SIPs, I would say. Probably in the next calendar year, when we start in that period, you could take a fresh, FIs could take a fresh, we could have to see how the allocations happen over there. But I think pre the elections, general elections, I think there could be some rally, and that's what we're seeing. I think after the favorable outcome of the state elections, markets are trying to believe that you would have a stable regime. So I think it's a rally which is could sustain, but again, one needs to have a more balanced view at this point in time. As I've been saying, that interest rates are also still on the higher side. I think at least in India, we don't expect any sharper rate cuts, right? We expect rates to remain at elevated levels all throughout the next calendar year. So I think some breather is probably required, and that's what I think you should see.
All right. Hi, Mr. Patil. Good morning and good to see you in. Nigel on this side. Mr. Patil, what about for 2024? Which is the top sector that you'll be looking at? Banks have come back into form after underperforming for majority of the year. But what's your view? The sector to watch of 2024?
So 2024, again, I think banks, as you rightly said, still looks fairly good, though they haven't done too great in this calendar year, though the earnings growth has been fairly decent. But I think if our view is that rates would probably, at least in India, would remain higher for longer, I think you would not see the NIM compression which one was expecting. I think not at least immediately. And overall credit growth has been fairly strong. Again, we are also seeing some pickup now on the corporate lending side, which has been weak for now many years now, and that's a positive sign which should expect the overall growth should be fairly strong. And on the credit environment also, I think the credit cost, we don't see any kind of a meaningful escalation over there. So I think banks, where the valuations are still fairly reasonable compared to where the broader market is, that I think looks good going forward. Even sectors like, for example, industrials and manufacturing is looking good, though it's done well in this calendar year. But there again, the overall investment cycle, I think private sector capex should pick up post-elections. I think the conditions are right now for that to pick up in terms of the corporate balance sheet, which is fairly delevered. Capacity utilization levels are also reaching a level above 75%, which typically triggers investment cycle to pick up. And assuming there is more confidence post-election, I think you should see that recovery also help the industrial and the manufacturing sector. Apart from that, as a defensive, pharma sector is something which pharma and healthcare, I would say, because the market, I think, has probably run up reasonably most on the cyclical side. But pharma, I think we see that their domestic growth should be fairly steady. US also, I think generic space, the pricing pressure is likely to ease off, and especially on the healthcare side, I think where we see hospitals, diagnostic, this is a space where the market share gains from the unorganized sector will continue to show better growth over there. And I think on the contrast side, I think IT sector, which has been kind of a laggard because of growth concerns in the US. If indeed, if we've seen the US that the recession is not really hard, then that's a sector I think which could continue to, which could probably bounce back in the next calendar year, because overall structurally, I think the spend towards digital and towards technology over a medium term, I think should continue to be there. I think despite the current cut in the discretionary spends, which we think is temporary, I think the medium long-term outlook there still looks fairly decent.
Okay, well, it's definitely sugar, which is really the sector of the day. We have Bajaj Hindustan, which has rallied 7%, Dwarakesh, Uttam, Kothari, Sakti Sugars, all of them up anywhere between 6 to 7%. So definitely a big up move, which is coming in on the back of the government relief. Mahesh, hi, welcome to the show. Would you have a view on sugar? You know, if you look at them, it's a mixed performance on a year-to-date basis. While they are rallying on the back of this relief, would they be fundamentally strong buys according to you?
So on sugar, we don't have a very strong view because, I mean, while the whole ethanol story is what has been driving, and I think the sector has seen some stability in earnings. I mean, earlier used to be the sector earnings should be fairly volatile and cyclical. Now with ethanol being a larger part, and there the ethanol blending policy which has been there has led to stability, and that's why we've seen this sector getting interest, again generating interest, and more importantly, there has been some re-rating of multiples. But again, I think some flip-flop in the policy has led to further volatility in this sector. I think if the policy on blending structurally that continues, I think then you could see the volatility in the sector should come down. And then in that scenario, I think it can be a sector, okay, where whenever there are these corrections, I think that can be an opportunity to look at the sector more positively.
Okay, all right. That's on the sugar space. But Mahesh, you know, you briefly touched upon banks, and I just wanted your thoughts on the entire PSU banking space. Just a quick word. Last week, the PSU space, the Nifty PSU banking index was up around 14%. Do you think that that's a good space based on valuations that one can still buy as a value add?
I think overall, as I said, the conditions on the banks are fairly benign at this point in time, and that's what is benefiting the PSU. Especially we have seen in terms of the credit costs, there are also strong recoveries which have been there on the past lows which have been written off, which is also helping in showing better profitability for the PSU banks. I think that will slowly kind of ease off. Having said that, I mean, the PSU banks are also now growing fairly decent. I think we see a lot of these banks are now focusing on the retail side of the book, which is gaining some traction for them. And I think at least in the near term, the outlook there still looks good because we're not seeing any kind of, because the biggest challenge for PSU bank comes in when there is stress on the credit quality side, which I don't think there is any reason to be worried about at this point in time. And while there has been significant amount of re-rating which we've seen on the PSU banks, I think there is still probably some scope there for them to move on. But I would say that, again, if I'm taking a longer term view, structurally, we think that private banks is where the place should be. And while the market share gains for the private sector banks have kind of come down, the pace of gains has come down because PSU banks are coming back in terms of credit growth. But structurally, we think that trend for market share gains, private banks will continue. And again, among the PSU banks which are slightly focusing more on technology and trying to make those investments, I think probably stand out within the PSU bank itself.
Okay, all right, Mahesh, it's been a pleasure. Thank you very much for joining in and speaking with us, and wishing you a great festive season and a year-end as well. Thanks very much for joining in. All right, so that's the word coming in on the markets, but let's get talking to a couple of companies. Cholamandalam Investment is in focus. The stock has surged around 70% this year so far. During its conference call, it indicated that the new business loan NPAs are below industry norms. Early vintage delinquencies have shot up, but it is not a concern right now. To discuss this and more, we have Arun Selvan, the President and the Chief Financial Officer at the company, joining in. Hi, sir. Thanks very much for joining in. Well, if we could just start by talking about your partnership business. There was some amount of a cautious stance which is taken in on the partnership business. Can you just explain to us, the details of it? What were the gross NPAs there and why the caution?
See, the partnership business is a very small part of our business. It's around 1.5% of our total assets. We have around 10 partners whom we are working with, of which we saw some higher spurt in delinquencies with 2 of them. So we have said we will be slowing down with them, and so we have reduced our outputs with them. While with the rest of the partnerships, we have been, moving ahead with whatever is as per our plans. We will certainly have a relook at it, considering the revised RBI norms and higher, capital risk weightage, etc. So we will have a slightly higher pricing and higher this thing, but it is not due to higher losses for the rest of the partnerships, other than the 2 which I mentioned.
Okay, all right. Hi, good morning, Mr. Selvan. Nigel on this side, and always good to see you in. Well, could you tell us, the RBI had come out with these new rules just a couple of weeks or so ago. So how much of your book will fall under this unsecured category?
See, if you look at the entire consumer and consumer and small enterprises loan business, we have around 6% of the overall book under this. This is unsecured, but almost 4%, almost 4% out of the 6% is lent to businesses, and so they do not come under the consumer lending, though they are unsecured in nature. RBI regulation is to address the consumer lending, which is towards discretionary spendings, etc. So I believe that this will be exempted from this particular, higher risk weightage. The balance. 2% or the 1.5% I was talking about is what would come under the purview of the new RBI guidelines. Rest of all our portfolio are secured and also of business purposes, where they are none of our portfolios are towards discretionary spend.
Okay. All right. So effectively, only 2% of your entire book will be impacted by these changes in terms of RBI regulations, right, sir?
Correct.
So that wouldn't be a very big impact then.
That is not. Sorry, that's not a big impact, and considering the fact we also raised equity recently, I don't think providing incremental risk weightage of 25% on this book is not going to.
You want to quantify it, Mr. Selvan, in terms of capital adequacy? How does it impact you and the cost of funds? How much does it? How does it impact both these 2 ratios?
On the capital adequacy, because of this particular portfolio being higher risk weighted, it would impact us by around 15 to 20 basis points. So the capital adequacy will drop around 15 to 20 basis points. On the interest cost, that's a slightly different, approach, because the interest cost will go up on the bank borrowings, which are not of priority sector. If you look at our total borrowing, we have around 1 lakh crore borrowings, of which around 50% is bank borrowings. But out of the 50%, almost 25-30% is priority sector borrowing, so those will not get impacted. The balance would get, slightly higher priced as they come up for repricing. We are seeing the impact of this on the borrowing cost. Overall borrowing cost would be in the range of, again, 15 to 20 basis points on a higher risk, higher cost towards non-priority sector-based borrowings.
Okay. So overall impact when you borrow from banks could be, overall cost of borrowing could go up 15-20 basis points, right?
Correct.
On that 1 lakh crore plus borrowing that you have. Okay. And this is all, you're able to pass this on.
Yeah, that's what I was coming to. How to mitigate that would be a mix of various approaches. One, certainly we'll pass on some part of it. Some part of it we will negotiate with banks and try to bring a little bit down on it. And then we have the OPEX and the NCL lines to also work on to make sure that the committed 3.5% ROTA pre-tax would be delivered as much as possible.
Mr. Selvan, just 2 points. One, you said that 6% unsecured, and you said the impacted portion is 2%. Is there, are you waiting for clarity from the RBI, or this is settled? I mean, in terms of what you need to do here, increasing.
It's a mix of. May not necessarily come from RBI, but it would be an approach we would have to discuss with our auditors and also look at the industry practice and take a call. The 20 basis points increase is considering all of them as a unsecured, not necessarily the 1.5%.
Okay, just a second
it would
point.
Improve. Yeah, it would improve.
Sorry, go on, please.
It would improve, or it will be slightly lower if it is done by the rest of only the particular 1.5-2% of the book.
Okay, many financial institutions we spoke with also spoke about the one is of course the actual impact and what it does, but this is caution from the RBI. That's a good thing, because otherwise asset quality etc. has been holding very good in the system. We're perhaps at peak rates, so rates will start to go down. That's another trigger. So this caution is well taken. Would you slow down overall? I mean, your unsecured book and your plans there. Could you talk to us about that? Because some have.
Yeah, see, the way it will happen is we need to price the higher risk weightage into the cost of this lending. So when we do this, automatically there will be some impact from the from the borrower side, that they may find it a little expensive. But as I said, we would be slowing down with regard to those two partnerships where we are having a certain amount of higher stress. But with the rest, we are continuing as per our plan. As of now, we'll see how it works out, because if the pricing works out unfavorably and that leads to drop, we are not going to compromise that by relaxing the underwriting norms. Our underwriting norms are set, so basis that we would be going with a slightly higher pricing.
Could you tell us who are the two partners? Could you?
Oh no, sorry, that may not be right.
And that no, so I'm just trying to understand whether this was two entity specific issues, or is it a more generalized issue? Since you're going ahead with the 8 but slowing down with the 2.
No, it is an entity specific because some of them are new startups also, so they might have become a little adventurous in what they were doing. But I think the traditional or the partnerships which have been for a longer time are continuing to be doing a good job on that.
Okay. Just quickly, sir, before we let you go, your outlook on your AUMs, best in 8 to 10 years, your asset quality improved in the previous quarter to 4.07, but it's still high as compared to, say, the previous quarters that we've seen for the company. On both these parameters, one, do you expect this kind of momentum on your AUM to continue? And two, in terms of gross NPA, what are you targeting, say, by the end of the fiscal?
See, the asset growth will moderate over the next 2 quarters. If you look at last year, the first 2 quarters were when we had not scaled up the loan against property and the home loan as well as the new businesses. And the last 2 quarters of last year was where we scaled up. So basis that, that denominator effect, you will see some amount of moderation from the 40% levels of growth or 39% levels of growth to a slightly lower growth. And as I said earlier, we should end the year with anywhere between 25 to 30% growth for the full year, year on year. With regard to the asset quality, the 2.07% you're talking about is basis the RBI new norms, and so this was not having a real comparison prior. So if the real comparison would be stage 3, which is the 90 days overdue, which we have also diverged in our investor presentation. Yes, you could see that has come down almost to pre-COVID level. And it will improve further over the next 2 quarters. As you always know, that the 3rd and 4th quarters are the one where the NPA numbers come down. So the 4.07 RBI new norms will also come below 4 in the coming 2 quarters, and the stage 3 numbers should also moderate.
All right. Mr. Selvan, very quickly, before we let you go, a couple of, directional, questions with regard to your business. Non-auto, I think, is close to around 40% now of the mix. How do you see that shaping up going ahead, and by when? If you could give us a broad outlook between auto and non-auto. And the second part is, some part of the street is expecting a rating upgrade, say in the next 12 to 18 months. Would that be fair? I think AAA is what you all are gunning for. Tell us more.
Yeah, see, if over the next 2 to 3 years, the auto part of our AUM would be in the range of around 50%, and the mortgage business would be in the range of around 30%, I would say, 35% between the home loan as well as the loan against property, and the rest of the businesses, the new businesses, would comprise of around 15%, of which the unsecured should be in the range of around 8 to 10%. With regard to rating upgrade, yes, we are working on it, but it's impossible for me to say what is in the minds of the rating agencies. Yes, we would love to have a rating upgrade, but we have brought in capital and we are looking forward to it, but it's purely up to the rating agencies to decide about it.
Some brokerages are expecting it between 12 to 18 months from now. You think so?
I would be happy if I could get it earlier, but
all right. Okay. Okay, sir. Thanks a lot. On that optimistic note, we'll let you go. Always good hearing your thoughts. Wishing you well for the end of this year and looking forward to chatting with you in 2024 as well. But for the time being, we'll slip into a short break. Up next, we'll have Sadaf Syed of Muthoot Microfinance, who will be joining in to talk about their IPO that opens later today. And later on, Nirja Kapoor of New India Assurance will be joining in to talk about the growth expectations going forward. You don't want to miss any of this.
CNBC-TV18, embarking on a quarter century of excellence.
Co-presented by
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. This is Corporate Radar, and you're tuned in to CNBC-TV18. Well, as we told you earlier, the markets opened under some pressure, but nothing really to worry about. We're down only around 30 points or thereabouts. But as promised, Muthoot Microfinance, the IPO opens today. It aims to raise closer to 960 crore rupees from its initial offer. It comprises of a fresh issue of around 760 crore rupees and an OFS of around 200 crores. Mr. Syed joins us here in the studio. Hi, sir. Morning. Thanks so much for joining in. Well, could you tell us, post this fundraise, what does your capitalization go to? And also, how does it change the ratio? And with this sort of capital, how long can you continue in terms of your growth?
Oh, good morning, everyone. Thank you. Pleasure being here. So we are raising around 960 crores, out of which 760 is primary capital. As of September, we are 1,842 crores of capital. So this will take us around to 2,600 capital.
Yes.
And we have been growing at a 36% CAGR for the last 3 years. We are a NBFC MFI focused at the bottom of the pyramid, providing financial access to women folks in joint liability group format. So the focus is financial inclusion, and we are taking digital inclusion also along with it. We are covering 18 states pan-India, and with branches of 1,340 branches spread across 329 districts.
Got it.
Catering to around 3.2 million customers. And the unique aspect about our business is that we, first of all, the parentage, we have a strong brand name, Muthoot Papachan Group, popularly known as Blue Muthoot. So it has been there for the last 130 years, for last 50 years in NBFC business.
Got it.
And
so just to understand, some more details, this capital that you're raising, it'll hold you in good stead for how long? As you said, you've been growing at the mid-30s. Yeah. Can you keep up the momentum? And this capital holds you good for how long?
Yeah, so I think the growth has been in, like if you look at the industry, the microfinance industry is growing at a 25-30% growth rate, and we have been growing at a 36% growth rate for last 3 years. We surely can maintain as the industry grows. primarily we are using this capital to augment our capital base and increase our branch network. So last financial year, we had added around 260 branches. This financial year, in the first half, we have already added 160 branches. So this capital will help us to add more branches, reach out to more customers. So we added around 7.5 lakh new customer last financial year. And this year already we have added around 4 lakh new customers. So we'll be able to reach out to more customers. So significant difference in our microfinance operation is that we are a technology-focused microfinance company. So we have an app called Mahila Mitra app, which caters to the bottom of the pyramid customers. So out of the 3.2 million customers, already 1.5 million customers are on this app. So this capital will help us to increase our reach and reach out to the more customers and use this app.
What is this? What is the risk to this 36% CAGR growth that you're seeing?
So I think the market, if you look at it in terms of the whole size of the market, there are around potentially 17 crores household that can be reached out in microfinance in the current definition. And right now, the industry is at around 7.5 crores of household have been reached out to. Definitely, there is huge potential to reach out to, and access to finance is, I think, as India grows, the demand will grow and people will need more finance. So I don't see any challenge as such. But we are a very risk-conscious organization, so we have taken adequate care to make sure that there is no challenge that we face. In fact, we have taken one of the challenge could be the natural calamity event that can happen, but we have a NatCat insurance for all our loans.
So just you're south-focused. We had floods in Chennai which took place. Any kind of impact in terms of your asset quality, in terms of your portfolio?
So no challenges there. We have natural calamity insurance, one of a unique product that we have. We cover all our loans, so all our customers have a coverage of 1 lakh rupees in any kind of an event, whether it's a cyclone, flood, earthquake or anything. If their asset is damaged, they have the cover. We get the installment and they get the cover for their assets. So from that event, we don't had any sort of an impact. And in terms of our geographic presence, we are pan-India kind of an organization, presence in 18 states. 51% of our portfolio comes from South, which is Kerala, Tamil Nadu and Karnataka, but increasingly 23% of our portfolio comes from North, around 13% come from East, which includes West Bengal, Odisha, Chhattisgarh, Jharkhand. We are not there in Northeast yet, and 12% come from West. We are seeing a lot of momentum in North, so increasingly more new customers would be acquired in that area.
Okay, Sadaf, tell us a little bit about aspirations and where you want to be in terms of loan book. Say in a couple of years down the line. What's the internal kind of thinking? How big and how fast? And also a little bit of margins. Where will that settle at? What's the steady state margin we should expect?
Yeah, so first on the loan book, we are at 10,800 crores of AUM, and we have been growing in the past at a 36% CAGR, and I think we have put in place fundamentals in terms of a branch network, a very good app and system, so which will help us continue the growth momentum. In terms of margins, we are operating at a 12.39 NIM. And our yield on the portfolio is 22.94%. And we feel that as the interest rate cycle turns, definitely the margins will improve. Part of it definitely will pass on the benefit to our customer, but part of it will also go into the bottom line. The two things which are impacting our profit is, one, the NIM that has expanded in the last couple of years, but secondly, we have significantly automated our operation, so which has really helped us to cut down our cost. Our cost to income ratio has gone down from 64% to 46% in the September quarter, and it'll further go down as
what period has this happened?
FY22.
Yeah.
22 to 20, the current.
Yeah.
So this is a dramatic drop.
Yeah, so a lot of use of technology. We have automated entire operating process. So we operate in a near paperless environment. Only whatever is regulatorily or statutorily required, we give to the customer. Otherwise, the app provides all the information to the customer. With the app, she can request for additional loan. She can check her eligibility. She can check her loan track record. She can check what is the status of kind of her repayment. So this basically, the app is an empowerment tool. Typically in microfinance operation, because these are deep rural area. So the customer are only dependent upon the field officer to interact with the company. But with this app, they're empowered to directly communicate with the organization. This app is available in 12 languages. So local people can use it. We have done a survey among our clients. Almost 84% of our clients have a smartphone.
Okay.
That is at the household level.
Got it. All right. And you mentioned, about this cost-to-income ratio coming down drastically from the mid-60s to the mid-40s. Where does it stabilize at? Point number one. Point number two, what about your return ratios? The ROE and ROA, both of them are relatively low in comparison to peers. So what's the target number there?
So if you analyze our return ratio, we are at 4.2% in ROA and 23% in ROE. Traditionally also pre-COVID, we have delivered consistently 4.5% ROA for 5-year period prior to COVID. So we believe that is something is achievable by this business easily. And with the growth momentum and capital coming in, definitely that will bring in efficiency. We'll continue to leverage on our technology. As I told you, out of the 3.2 million customer, 1.5 million customer are on this app. We feel that 84% of the customer base has this smartphone. So more can come on this app, which will bring in efficiencies of operation and also cost to income will go down.
Okay, just on asset quality, your 90 DPD, what would it be?
2.37% as of September.
And is it pre-COVID levels? Is it at pre-COVID levels? Give us a comparison on where it is.
So if you look at COVID was, of course, a very big moment. And during that time, peak delinquency was around, our GNP was 7.39%. It has come down to now 2.37%. And this is, net NPA is at 0.33%. And this is basically driven by our superior underwriting. So we have developed a scorecard with the help of Equifax, understanding the 6.5 crore live customers and their credit behavior and identifying 40 parameters which influence their repayment behavior and giving them weightage. So each customer is given a score, and based on that score, they are categorized into 4 categories: low risk, very low risk, high risk, and medium risk. So we focus on low risk and very low risk customer. And typically in lending business, there are 2 types of mistake anybody can make. One is lending to a wrong customer. Second, that is type 1 error. Type 2 error is what we call, you have a good customer in front of you, but you don't give the right amount to that customer. You give them a standard product. So this scorecards allow us to focus on that good customer and allow her to give right kind of loan. If you look at post-COVID, post-June 2021, that is second wave of COVID, which represent almost 97% of our book today. The delinquency GNP has been only 0.67%. So that is the quality of the book that we are maintaining.
All right, Sadaf, we leave it there. Good luck. Thank you very much for dropping by into our studios and explaining the business to us and our viewers. Thank you indeed.
Thank you
for joining in.
Thank you.
All right, well, let's move on. The market, by the way, has made a full recovery. We are down about 27. Actually, it had made a full recovery. It's down from that point. It's down a little bit, 25 points. 21,430 odd is where we are at. But still, stocks are off the lows by quite a margin. New India Assurance, has spoken exclusively with CNBC-TV18. My colleague Yash Jain caught up with the company. They remain optimistic to grow in line with industry from FY25 onwards. So here's the conversation with Neerja Kapoor, Chairman and Managing Director at New India Assurance. Yash started off by asking her about their growth expectations for the third quarter gross premium and for the full year FY24. Listen in.
Overall, we expect that we would close this year at a growth of about 8 to 10%, like I mentioned earlier. Last year, we had completed a premium of about 38,000 odd crores, including our foreign offices. This year, we expect to close at about 42 to 42,500 crores. Because, like I mentioned earlier also, we are not just looking at the growth aspect, because if you want to grow, you can grow exponentially also, at about 15%, 20%. The idea is to grow and grow in the right direction, and also at the same time to constantly, as we review our business mix and to constantly weed out the, concerned businesses which have been loss-making in the past. So the final growth figure, on one side you would be growing in the right direction, the other side you would be weeding out the loss-making businesses. Okay. So the end result is likely to be in the range of 8 to 10%. Yes, okay. But after that, maybe in FY25, as you mentioned, because last year also we shared about nearly 1,000 crores in a loss-making business. This year also till date we have shed about 500 odd crores in loss-making businesses. So, once this process is reduced to some extent by the end of this financial year, we would be growing in line with the rest of the industry from next year.
That would be about 14-15%.
Whatever the industry is growing with, yes.
Your Q2 underwriting loss, that increased about 62% on a year-on-year basis, 66% on a quarter-on-quarter basis. I want to understand from you, which are the culprit segments that you see as of today, which are bringing this majority of the losses to you, and out of those segments, where do you expect a significant turnaround, which ultimately would reduce the overall underwriting losses for you?
The main segments which have contributed to the losses till now in this particular for the first 2 quarters has been motor and health. These are the 2 sectors which actually contribute to the maximum growth also, as well as right now they're contributing to the maximum ICR, the incurred claim ratios also. But we are taking a lot of steps in both these segments to reduce the losses. We've also had some losses in the first 2 quarters, predominantly from catastrophic claims like Cyclone Biparjoy, as well as the floods in the north parts of North India and northeastern regions. And very recently we've had the Chennai flood losses. So yes, these have impacted the books to some extent, but looking to all the measures that we are taking, plus the corrections in the price of the various policies, we expect an improvement in the incurred claim ratio.
Motor and health, you said 2 biggest segments. Where are the loss ratios in both segments currently? By when do you see things that you're doing starting to materialize? And by how much? How do you see those loss ratios coming down? What will be the progression on that front?
See, motor, for instance, you have to take it you have to look at it holistically. It comprises of 2 segments. There's the own damage and there's the third party. Now, the own damage segment, we are seeing a significant improvement because this particular segment has actually grown many-fold compared to the previous years. So, to a large extent, the motor OD loss ratios have come down. But on the other hand, the third party segment, since the prices have not been corrected this year, we have not seen the improvement in the price happening in third party. So to that extent, the ICR of the motor third party has gone up. Yes, the motor OD claim ratio, currently combined claim ratio is in the range of about 94%. And we expect this to come down in the coming quarters with continued increase in the motor OD premium, as well as corrective steps that we are taking in both the motor OD claim settlement and faster settlement in third party.
Any progression that you'll put to this thing? I mean, to what level do you see realistically it should be at? What will be?
See, in all the segments, we are hoping to improve by 5 percentage points in all the LOBs. So this is our expectation and we are working towards that.
Another thing that I want to understand, you did allude to it, and that was the correction as far as the motor third party premium is concerned. Did not come through this year. What would you expect in terms of a blended basis, in terms of increase that is required for you to sustain the portfolio, let's say for New India? Second thing that I want to ask, there's a consultation paper out which talks about deregulating the prices in motor third party. Would you expect the prices to go up in a deregulated scenario or to come down?
If it is deregulated, you would find that there would be a huge impact on, or a huge increase possibly in the premium rates in some segments or some parts of India, because there is a very unequal distribution of the claims experience when it comes to motor third party. So it may not be exactly in the interests of the policyholder at this point of time. So we do expect that it will continue to be regulated for some more time. And we would also expect that IRD and MORTH would work together and get a reasonable increase in the rates, a correction in the rates, to be commensurate with the inflationary trends as well as the increase in claims that we are seeing in third party.
For someone like New India Assurance, what is reasonable?
It will be difficult to mention that exactly, but yes, 4 to 5% increase in the third party premium.
Now let's address the big point, that is combined ratio. As far as the second quarter is concerned, it came at about 131%, increasing from about 121% when you look at it on a year-on-year basis. This has been increasing, and this is sort of accumulation of the losses that you got from various segments. What I want to understand from you is that the industry is somewhere between 115 to 120%, different players. By when do you expect to reach that 115% mark? Could that be done in the second half itself? Is that a possibility for New India Assurance? And then once that is achieved, every year, what would be your target in terms of by how much would you want to reduce your combined ratios?
We would expect the overall increase in the management expenses to go up by about 1 or 1.5 to 2, maximum 2%. So looking at, reducing the ICR by 5 percentage points and the expenses of management going up by about 1%, we do expect an overall reduction in the combined ratio by about 4 to 5%.
4 to 5% by FY24.
By FY24.
So then you will be about at what level?
At what you were mentioning, at about 115. Last year we were 117. So we should definitely be less than 115.
And then each year, what will be the target in terms of reducing it and adjusting?
Gradually about 3 to 4% every year. Okay. That would be the targeted.
All right, that's New India Assurance. That stock has risen over 75% on a year-to-date basis. So strong performer there. We need to take a short break. Up next, we'll put the focus on the commodity space. Manisha Gupta will be with us. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter-century of excellence.
Welcome back. Well, around a 90-point recovery from the lows for the Nifty. So it is just about flattened out and probably going to make a move into the green as we speak. The broader markets have already recovered quite smartly. So up around 0.2% in the green for the mid-cap index with an advanced decline ratio, which is firmly on the advancing side. So 2,100 stocks advancing to around 1,225 stocks declining at on the Bombay Stock Exchange. Good time then to get in some technicals. We have Mitesh Thakkar joining in now to discuss what he's strategizing at 10 a.m. this morning. Mitesh, over to you. What's your call?
So, good morning. The early morning idea was that the gap down, possibly if it sees some more selling, try buying closer to support areas of 21,300, 250. We actually got a low of only 21,365. But yeah, the trend remains on the upside, so maintain a long bias. Today, I think it is the Nifty Pharma Index, which is showing some good traction. There's a bullish breakout taking place over there. So I think that could be an area in focus for the next few days with the breakout happening today. The stocks which I would recommend, one, Divi's Lab, disclaimer, it's a recommendation to our clients, so we have vested interest. Divi's Lab is a buy with a stop below 3,700 for targets of around 3,850 to begin with. And the other one is Zydus Life. Again, a disclaimer, I have futures positions, so there's vested interest here. That's breaking out into fresh highs, fresh swing highs. So buy here with a stop below 660 for a target, or 659 for a target of around 710.
All right, Mitesh, we'll leave it there. Thank you very much for joining us and running us through those trading ideas. Manisha is standing by with the commodities corner. What's hot? Manisha, morning.
Thank you for that, Prashant. But I'm looking at sugar because this is a sector that will be in news for the next couple of days as well. While we have seen a U-turn come in from the government, there has been a change in government stance after representation from the sugar industry. We do understand that there were 3 meetings in the previous week itself where there were representations from both the ministries as well as the PMO office, and we have the final notification coming over the weekend there. So the government has reversed decision to ban the cane juice for making ethanol, and that is where the support for the sector is coming in from. We also are looking looking at this getting reversed from the 7 December's notification, where the government had prohibited with immediate effect any use of sugarcane and syrup for the making of ethanol. Government has put a cap, though, on diversion of sugar and B-heavy for ethanol at 17 lakh tons, which the industry feels is sufficient at this point in time, with a promise, of course, that there would be a monthly review onto this one. Officials also suggest that 6 lakh tons of sugar is diverted for ethanol already. So you have a cap of perhaps 1.1 million tons on the higher side there. We do also understand that out of the 157 mills which are engaged in ethanol manufacturing, 20 of them make it from cane juice, and these were the most impacted, and there is some relief now coming in for many of them there. It also is about the cap in place for 2024 as an year, which ends on October 23-24, and this would be reviewed on a monthly basis. That is what industry does feel, that you could be looking at changes going forward onto this one. This is what we have as a picture in sugar output estimate, and is the reason that you have seen all of these changes come in. So while last year was 37.3 million tons of sugar production, this year is around 33 million tons, 8% lower than what we saw in the previous year, is the reason you have all this confusion and concerns coming in. Now, with that kind of a production, the domestic consumption is seen at around 28.5 million tons, with the diversion that we're talking about at this point in time is at 1.7 million tons, and the opening stock that the government is talking about is at 5.8 million tons. If we are looking at this capping coming in, then there is more sugar that you can be expected within the system. These are the ethanol blending targets which we have been talking about, just reiterating on this. So we did do 12% in the previous year, 15% is what we are looking at for this year, and 20% by 2025-26 is what the government's target is. So with these kind of targets in mind, whether it is about ethanol or ethanol to be produced from, grains, etc., the government will be looking to watch this number there. This is what the street is anticipating now, and this is going to be the big news for the next couple of days. The ethanol price revision for this season is yet to come, and the expectations are that you could be looking at 64 a litre B heavy from 59 that we have currently, and a 10 rupees per litre of an increase is what C heavy is also expecting. Now, tomorrow is the cabinet meeting, and this could come in as early as tomorrow.
Okay, all right. Thanks a lot for that, Manisha. Well, let's move on then. Sources tell CNBC-TV18 that the revised letter from the government has dropped in post-merger scenario portion. Sapna Das joins us on the phone line to fill us in with more details on that front. Sapna?
Yeah, hi. So that's right. This clarification, of course, it's off the record at the moment, has come through on the weekend. Basically, the letter that had been shot out by the government to the parliamentary panel in terms of their study visit to Bombay and Goa, spoke about this, post-merger scenario. That line has now been removed. It does create a sense as to whether there's something on the cards, on the table, in terms of any merger plan that the government may have thought about, because obviously, stake sale or disinvestment of particular banks has not really gone forward. That's an expectation post-2024 general elections. So in the meanwhile, is this also something that is playing the mind? Well, sources are indicating absolutely nothing on the table. On the cards, no question of any further budget talks as of now. This was a misrepresentation of the words mentioned in the earlier letter that had been sent, and the letter stands revised now. The second government sources is that if you really want to talk about merger scenario, UCO had already absorbed Corporation Bank and Andhra Bank way back in 2020, and there is no further cause for any kind of a speculation on this front. However, Nigel, the question is still open-ended, because unless government comes on record and puts it straight, people will still talk about it. And also, let's keep in mind that UCO, BOI, all these players and Bank of Maharashtra were not part of the merger scenario in 2020.
All right, Sapna, thank you very much for that. Great to get those details from you. Let's talk about the IIFL Group now. I mean, the group has done pretty well in terms of earnings, and stocks have performed very well as well. I mean, you look at IIFL Finance, you look at IIFL Securities, or you look at the wealth management business. Now, the group is, IIFL Finance is laid out as a 525 guidance, which is a loan growth of 25%. There is so much to talk about as far as the group is concerned. Nirmal Jain is founder and chairman of the IIFL Group. Mr. R. Venkataraman is co-promoter of the IIFL Group. Mr. Venkataraman, of course, looks at the IIFL Securities business pretty closely as well. He's the chairman there. Gentlemen, great to have both of you here. Thank you very much for your time, and congratulations on what has been essentially a remarkable journey. We speak with, one of you, but I think we have both of you for the first time. At least we've not had both of you together in a while, so it's great to see both of you. Thanks very much. Prashant, this side. Mr. Jain, if I can start by asking you with something very current and newsy. The RBI increase in risk weights, Mr. Jain. What's the impact at the NBFC, both from a sort of bank borrowing level and, of course, on the unsecured portfolio when you lend?
Okay. Thanks, Prashant. So RBI's increase in risk weightage, I think, is really proactive and I would say a very timely decision because there has been very aggressive lending in the personal loan space, unsecured personal loans, and particularly by new age fintechs and new NBFCs. And many times they are funded by private equity and they try to chase the volume target. And sometimes that can get into some, obviously, credit selection gets compromised. So as far as we are concerned, our personal loan book is about 4% of our total loan book. And our personal loan strategy primarily is co-lend, is cross-selling. So what we do is that our customers for home loan and gold loan, who have had a good track record, we give them kind of a top-up loan, which is in the form of personal loan. But even that has slowed down now and is a very insignificant part of our business. Also, what RBI has done is that lending to NBFC, they increase the risk weightage, but there are exceptions. And housing finance, microfinance, and priority sector, I mean, this bulk of our business, almost entire incremental business is not impacted by this. So, the impact of RBI guideline will be minimal. There'll be some risk weightage increase on a personal loan portfolio, which I said is not very significant, but still it will have a very little impact on our capital adequacy.
How much, Mr. Jain? I mean, would you, very minimal as you said, but
there's a few basis points, I would say maybe around 10 basis points or so on the capital adequacy, which is, as I said, is insignificant.
We just had the management of Chola Finance with us 15-20 minutes back, and they actually said something similar to what you were saying. They had 10 partners in the new business. They said, we've dropped 2 partners, and they said, I asked them, who are these 2 partners? They said, well, they're startups, fintechs, and they got a little too adventurous. Something similar to what you were saying, Mr. Jain.
I would equal similar sentiment. That some of the new fintechs were getting too adventurous, and that is where RBI has been very proactive in just making sure that this doesn't, grow to a bigger problem.
Is this an entity problem, or do you think this is the size of the, very small, under 50,000 rupee loans where the problem is?
Yeah, 50,000 rupees, even smaller, I would say 5,000, 10,000 rupees loans, sometimes in the nature of buy now, pay later. And then that, once with a very short-term track record, they offered personal loan and, many times what happens, supposing a customer has a credit eligibility of, say, 50,000 rupees. And suddenly he gets 50,000 rupees offered from 4 players, and he might end up borrowing 2 lakh rupees. And I think, so that is one scenario. The other scenario is that the new models which, try to offer credit to new-to-credit customers, they are relying on certain parameters which are not time-tested.
Hi, good morning.
This impact will be, I think, much lesser on the established NBFCs who have been traditionally in the business of lending for many years, but it will impact more the new age NBFCs or new age fintechs, that have just started in the last few years.
Okay, all right. Good morning, Mr. Jain and Mr. Venkatraman. So we get that clarification, Mr. Jain, that the impact of RBI's recent, changes or announcements will be minimal in your business. But you have a bigger goal, right? You want to look at taking your AUM to around 1 lakh crore rupees with profitability spiking up as well. Tell us, how do you see growth pan out from here on? And what would the contribution be? As of now, I think home loan, gold, LAP, they constitute nearly 50-60% of the book. So how do you see that changing going ahead? What should the mix be?
So, Prasad, I'll just tell you a little bit about how our business model is and how we are going to achieve this. So what we are, our business primarily focuses on customers and geographies that are not catered to by bank in a meaningful manner. Either banks find it difficult or unviable to reach out to small customers. So when we are talking about loans of say 50-60,000 rupees of gold loan or 2 lakh, 3 lakh rupees of the unsecured business lending, and also in geographies and areas which are remote and states which are not really well covered by the banks. So that is a segment that we target. That is the target customer that we have. And as the economy is doing well, the credit penetration still is poor. The demand for working capital loan by small businesses is increasing. Many of them borrow against gold, and many of them, who are not able to get the unsecured lending. Similarly, if you look at the affordable home loan space also, these are our ticket size around 15 to 16 lakh rupees. So what we are talking about is the value of the apartment or home will be around 20 lakh rupees. So you can imagine that they'll be in the far suburbs of cities or in smaller towns. Again, the reach of traditional banks and larger HFCs is very limited there. Microfinance also is growing very well and is a business which is very closely linked to the economic activity. And whenever the economy does well, you'll see that the microfinance volume growth as well as the credit quality and collection efficiency improve. So as of now, all our businesses are bet on the faster economic growth, and credit penetration in India is still much, much lower than what it ought to be. Just to give you some data point,
sure.
Say in case of MSME unsecured business lending, the market will be about 90 lakh crores. We are, hardly not even 0.1% of the same. If you talk about gold loan, then the stock of gold in India is around 28,000 tons. And incrementally, we get about 800 tons of gold import, primarily which gets converted to ornaments and jewelries. If you look at the gold in our vault, is around 60 tons. So I think the opportunity to grow is significant. What we have done in the last 2-3 years is that expanded our branch network, because all our small ticket retail business is distribution led. We set up almost about 1,000 branches, more than 1,000 branches in the last 2 years. And
sure,
now,
Mr. Jain, due to paucity of time, I'm just going to... Sure. Mr. Jain, I'm just going to interrupt you due to paucity of time. We just had a quick question for Mr. Venkataraman. It's been a very strong year for the capital markets business, IIFL Securities, iBanking, and, you've led a lot of the IPOs. Going into next year, what is the outlook? Do you expect a little bit of this euphoria to probably scale back a little bit? And also on your private wealth business, we have big players coming in. We have, Reliance, which has thrown its hat in the ring, HSBC, which is restarting. In that context, give us an outlook on what the next fiscal looks like.
Thank you. And what we want, we are very bullish on the India story, and we are very bullish on the India macroeconomic. So long-term perspective, the entire sector related to capital markets looks very sanguine. And so basically, we are very well positioned to capitalize on the India story, because we have invested a lot in talent. Our management bandwidth is very strong. We also have invested in technology. We also have capital. We have built a brand. And most importantly, we also have a distribution reach across the country. So I think even if there is some cyclical variation, maybe 1 quarter or 2 for a correction, simply because the markets are run up very sharply and the returns are front-ended, on a long-term perspective, the long-term prospects of this segments are very good. Coming more specifically to investment banking and institutional equities, I think the institutional interest in Indian stock markets are very high. We are seeing a revival in private capex, so more and more companies will tap capital markets to fund growth. And in that segment, given the fact that we have a very strong research franchise, we have a very strong relationship with all the long-only institutional investors, and most importantly, we are one of the few bankers on street who have the capability to fill all the 3 buckets of the IPO construct, the ECM construct on our own, be it institutional, be it retail, be it HNI. We are very optimistic about the prospects. And one last point I want to just add is that in India, competition is always given. It's a matter of time. So I don't think in any business we have seen a kind of lack of entry of competition. So, and we have been in this business for the last 28 years, and we have seen cycles. And so it is up to us to build a moat, and it's up to us to build a talent and make sure that customer requirements are taken care of, and we will surely forge ahead.
The securities business, Mr. Venkataraman, what kind of growth should we expect? What should be the growth rate? What will be the growth rate?
No, it's very difficult to give a number on the growth rates because, as you know, growth is a function of capital markets. And in the last 2 quarters, we have seen a huge tailwind to the industry, be it in terms of trading volumes, or be in terms of deal acceleration, or be in terms of IPO. So in my guess is that, and also most importantly, business is not built on a quarter-on-quarter basis, but on a long-term perspective. So on a long-term perspective, I think we are confident of growing at high teens.
High teens, okay. You know, when you said it depends on capital markets, I thought that was a settled issue. That capital markets are going to be good for a while. At least that's the view. That's the consensus view.
In spite of the cyclical blips in the capital markets, if you look at our business construct, we have a retail business, we have an institutional business, we have institutional equities, we also have financial products.
No, absolutely.
And lending. So, given that we have 5 engines of growth, I'm sure one of the other will make sure that
Absolutely. Mr. Jain, just a last question. The wealth management business is also getting a lot of interest, seeing a lot of interest. Just, right, I mean, and you've done well there. The stock's done very well in the recent past. What's the vision there? What's the market share currently? What are the plans there? Briefly, sir.
So, I think our market share in HNI, ultra HNI segment is around 4 to 5%. No official data on this, but I think we try to make the best estimate of it. India is probably the country where wealth is growing at the fastest pace, and we are amongst maybe the leading player in the space. So there's a tremendous trajectory for growth, and we have a 3-pronged strategy there. One is that we use digital technology and offer the similar products and services to mass affluent segment. And 2, will geographically expand. So we have about 20 centers now. Our footprint will expand to 50 cities in the next 2 to 3 years within India. And globally, I think there's an NRI concentration in Dubai, Singapore, and London. So we'll expand our operations there and tap that market opportunity as well.
Okay. All right, Mr. Jain, Mr. Venkataraman, it's a pleasure. Thank you very much for joining in and talking to us and giving us a perspective on all of the IIFL Group companies this morning. Thanks very much for joining in and wish you a great festive season as well. On that note, it's a wrap on Bazaar. Stay tuned. Chartbusters up next.
CNBC-TV18, embarking on a quarter century of excellence.